members wanted to look at the UBT ETF, so it's the 20-year Treasury bond ETF. This mimics the longer end of the yield curve, the 20-year Treasury. If yields fall, so interest rates fall on the long end, the 20-year falls, this bond ETF is going to go up. And I believe there was something to do with the volume and the buying pressure. Just noticing on the daily chart, you have put in this little bit of a nasty reversal candle. This is an intraday daily topping tail, so the likelihood of more downside to follow from this candle alone, it suggests that you should go and retrace back to support, which would likely be this gap fill. I imagine that since you have that topping tail, you're likely going to come back down to this 32 level, retrace to support, fill that technical gap fill, which means that interest rates are most likely going to see, at least on the long end of the yield curve, the 20-year, are going to rally a little bit more. I usually look at more of the 2s and the 10s. I find the 2s are my short term and the 10s are my long term, so I don't really I do look at the 30-year occasionally, as it does affect more of the housing rates, but overall the 2s and 10s are my preference. But the UBT will give you that same thorough longer term analysis of what the bond market and the credit markets, what type of shape they're in. And if we simply look at this drawdown, I mean, what a drawdown. Like, we're talking about a high here in March. So the interesting thing is, this was your COVID collapse where, the Fed lowered interest rates to basically zero. And look at this run up in this UBT. I mean, that's a tremendous game. I mean, this is very, very interesting, because if you do believe there's going to be a crash coming and policymakers are going to lower rates again and be more accommodative, then certainly this can be a lucrative opportunity. So simply a 70% rally, and notice how this started rallying early January, kind of sniffing out a little bit of a COVID crash before the actual crash happened. But the actual crash is where you make that killing, that blow off top. And then obviously, all good things come to an end. This ended up crashing and then rebounding again as the rates markets were trying to figure out what the hell was going on. But nonetheless, a massive drawdown in this UBT, this 20-year Treasury. So right now what I'm seeing is that, yes, you are into support. You're extremely oversold, so the bounce can continue. Over the coming 1 week, you should pull back a little bit, retrace and fill this gap. But overall, if you look at the weekly time frame, you are putting in this beautiful basing formation and held by a weekly bottoming tail. And so far, if you can get a third weekly positive green candle close above this wick high, that would be a very, very bullish candle formation. Essentially, you want to see 3 candles to the upside. That does confirm a short-term change in trend. If we flip to the monthly chart, I would have liked to see a monthly bottoming tail, because overall you do on a 1, 2, 3, 4, 5, 6. Yeah, you are on a 7 monthly time count to the downside, with obviously this one just started. So you are still extremely, extremely oversold. I'm in the camp that rates can move a little bit higher, and I don't think they're going to do that yet. They certainly have put in a little bit of a topping formation where they do need to consolidate, but we're at this period where the economy is getting in trouble. Inflation is still high. Rates should technically, on a mathematical base, move up higher against the inflation rate, but with the economy being now, outlining the threat of a recession, and more mainstream picking up on the threat of a recession happening sooner, most analysts are thinking a recession in 2023, but we were always calling for a recession to start quarter 2 2022, a recession to basically be technically announced quarter 2 2022, because of the 2 consecutive quarters of declining GDP, which is looking like we're now going to fulfill that metric. But overall, most people were pricing in a recession in 2023. So the question is, interest rates are at this weird inflection point. The Fed is at a rock and a hard place. The economy is definitely going to slip into a recession. If the Fed keeps tightening at the rate they are, then they are going to make this a much worse recession, and arguably a big crash or a depression, so to speak. But we haven't had to live through a depression because of this loose economic policy where they lower rates, they print $1 gazillion, and everything starts up again. We start kicking the can down the road. So interest rates, the Fed are stuck right now because of the inflation is still too high, but the economy is faltering. And the question is, the bond market, I think, is kind of confused as well, which is why we're seeing these massive swings in either direction. Because if rates move higher, it's going to crush the economy even more. But if rates don't move higher, then inflation is still going to be rampant. So we're at this catch-22 where it could go either way. I'm still in the camp over the next 2 to 4 weeks, rates consolidate to a lower range, which should lift this UBT and the long IEF position that we're in. But nonetheless, they still could potentially keep raising, which should price in higher yields and which should lower these UBTs and IEF positions and TLT positions. But at some point, I do believe these are going to rocket to the upside. When that crash happens and the Feds have to come in with lowering rates, this is when you see these ETFs or these treasury bond plays really start to take off. And certainly if you see this type of move over here, that's just the tip of the iceberg. I mean, the fact that you're now starting at a lower point on the chart, you could have a rally of epic proportion. I mean, just from the lows here, you know, if you had to go to the highs over here, that's talking about 100% rally. Imagine if you went all the way back to the highs up here, which makes sense because this was your COVID crash. This is when rates went to zero. So let's just say the Fed raises or lowers rates to zero. You're talking about 183% rally. I mean, we're off the lows now, but even still 148%. So that's just the power of being on the right side of the cycle and not getting caught up. Now, there was something to do with the volume. Let's just take a look at the volume. Let me just erase that. So right away, I do notice that there is a increased spike in volume. Now, one of the things that I'm just going to mention is that we should be careful when we're analyzing volume, because specifically you want to take into account when you have a high volume day and kind of an outlier event day. You know, you had some volume spikes here, but overall you want to take into account which day it happened, and this just so happened to be the last day of the month. So typically we see these massive inflows of money either on the last day of the month or the first day of the new month. So this was on the last day of the month. Quarter 2 was ending. Money was rotating around into many different sectors. If we simply look at this, here you had a December 22nd, so near the end of the month. You know, not quite the end of the month or the beginning of the month, but near the end of the month. But also, if you notice that there's a high volume candle over here, which just so happens to be this little candle, it didn't suggest that there were many buyers there. It just suggests that there were more buyers on that day, but there were a ton of sellers as well. It's distribution happening. So just because you see a massive wick doesn't mean that was all buying pressure. That means that there was a lot of buying pressure and there was also a lot of selling pressure, but there was overall more buying pressure than selling pressure. So just because you have a massive volume day doesn't mean the price action is going to head up. And if we simply look, if we go a little bit more down the charts, you can see here, August 31st, end of the month, you had a massive volume candle. Also over here, beginning of the month, March 2nd, that must have been your first trading day because February 28th was your last day. Massive volume candle. Simply if we go all the way over here, again, April 6th, which was roughly the first week of the trading week. So again, another influx. So we have to be very careful with the volume. It does just mean that there's lots of distribution happening on that candle. So clearly as buyers were coming in, you can see by this little wick there were sellers stepping in as well. But overall there were more buyers on that specific day than sellers, but there were a load of both buyers. But this daily topping tail I'm not liking at the moment. I think you come back down to this 32 before staging a potential another rally up. You'll have your first major resistance over here around this 35 mark. That will probably correlate with around, I think, 2.5% on probably the yields. But we'll just have to continue to monitor that. I may consider going long if we get a necessary retrace back on the Treasury, but I'm already long the IEF, which is the 10-year. So if we just simply look at that, you can see it also had a massive inflow of volume on the 1st of July, clear money rotation and distribution happening. But notice how this topping tail didn't close negative on the day as opposed to the UBT. So this one still shows there were more buyers on the 10-year versus the 20-year. So something weird is happening on the long end of the curve that I just don't know about yet, versus there was more strength on the shorter end of the curve. So we'll just have to continue monitor yields. I do think they're going to be the best forward indicator and leading indicator for us to potentially prepare for a market crash. I would love to capture a magnificent, week's decline in terms of us seeing some sort of a black swan crash in the markets. Typically, if you do look at the federal fund rate, it did show a collapse coming in the economy before. Let me just pull up the chart here. We flip to the monthly chart. So right over here, you had a sell signal in equities February 1st. The real COVID low was March 4th, I believe, when you actually hit the rock bottom. And basically the whole world, or mainstream Western countries, were announcing COVID had hit, was around the beginning of March. So you had a whole month to prepare for this massive downturn in the markets. And this was the federal fund rate collapsing in response to support the markets. And notice how it was late to the punch. I mean, you had a bottom in the S&P around, I believe it was March 3rd or 4th, and they only responded April 1st with accommodative policy. So they're always lagging in terms of the data that they do, in terms of the response. They always try to say they're going to prevent a crash and save a crash, but ultimately they can't prepare and save a crash. The markets are going to do what the markets are going to do, and then they're going to come in with their easing policy and support the markets once the crash happens. They need these boom and bust cycles. That's the way they can continue the fiat monetary regime, by cleansing the system of over-leveraged people that get too aggressive and inconsiderate in how they position their portfolios. So, and basically greed, they wipe out all of the greedy people. But lots to discuss in terms of rates. Let's continue to monitor the markets. I do favor a little bit of slight upside over the next 1 week. But overall, let's enjoy the long weekend. Happy Canada Day. Happy July 4th for any Americans out there. But let's enjoy this long weekend. The U.S. markets are closed on Monday. The Canadian markets are open. So I will certainly be looking at a little bit of action, but overall the volume will be extremely light on the Monday just due to the fact that the U.S. markets are closed. That being said, everybody enjoy your weekend. Thanks again for being members and subscribers. Hopefully all this analysis helps. Lots of confusing things around yields, but slow and steady wins the race. We'll continue to touch base on many different aspects of the economy and stock market as we progress through this bear market.